Ladies and gentlemen, welcome back to House Rules, a real estate and mortgage podcast. I'm John Binkowski, realtor at Century 21 Signature in Flushing. Carter, you want to tell the people who you are, what you do?
Carter Bastien with the line lending, the numbers guy, the money guy. You need financing on your home, whether it's regular, conventional, or government financing. I've got non-QM programs. I've got everything you could need to make sure you can get into your home. I can come up with a solution for you. I got you.
Perfect. In a nutshell. All right, today we're going to be talking about the cost of waiting. How much does it cost in the numbers? Well, we might have to ask the numbers guy on that. How can we keep more of that money in our pocket, but also avoid losing more money that might not be realized? Because for those of us that are renting or living with mom and dad, you might not think that you're losing out on money, but in reality, you are. You already lost money. How can we start the new year on the right foot and avoid losing money? Carter, what do you got for the people?
Well, John, you and I both 30 years old, 10 years younger than what the average is for a first-time home buyer in the United States now. The highest it's ever been, 40 years old when somebody's buying their first home. That's an issue that we're both passionate about, is bringing that age down. And I think it's quite the conundrum because there is so many things that are going into it. I think a big part of the reason why people are not buying their first home until 40 years old is because they can't afford to, or maybe they think they can't afford to. And it's on us to provide them the education, resources, and knowledge that they need to be able to at least make an informed decision and not just count themselves out and miss out on the appreciation and the value gains that they could be getting, even with a conservative estimate of appreciation, is going to offset any benefit that you could get by trying to wait out the market when you don't even know what interest rates are going to do.
Absolutely. Not only that, but you've got buyers out there that maybe they weren't buyers or weren't ready to be buyers. They were finishing college, or I think we're in that boat where we're finishing out college and we're like, you know what, I'm going to get a job. I'm going to rent for a little bit, and then I'm going to go and buy a house. It's not going to be the hardest, most difficult time in American history to buy a home for a first-time home buyer. We couldn't have been more wrong about that. Because it turned out to be the most difficult time to buy a home. You know what? I'm just going to hold out for the next crash. I'm going to wait for prices to drop. Nobody could project that. Nobody could predict that with a crystal ball or without one. They seem to find higher highs every year and then plateau and then remain on that upward trajectory, but not have any sign of coming down, even slightly. Looking back into the past 6 years, we haven't seen that breathing room. Based on past projections, it's only going to cost you more to wait. Even if prices do go down a little bit, you've already lost money. So how do we tell people that should be in the buying pool that maybe think they can't be? At least exercise your options. Figure out your options, whether you can or cannot, because if we don't have a pre-approval letter, and we see the home of our dreams, we go and I show them on a weekend, if we don't have a pre-approval letter, we can't put an offer in on that property.
Let me share with you a stat that I think is going to put things into perspective. The average net worth of a homeowner versus a renter is also at an all-time high. The average net worth of a homeowner is 43 times that of a renter. Of course, your landlord thanks you for waiting, for not buying a home. Well, let me share a story about Brad and Chad. Brad decided that he was going to wait. He thought that, now's not the right time. Maybe he could time the market a little bit better. So he's paying $1,800 a month in rent. Chad decided he was going to buy a home during that same time. A home he bought for $265,000. Now he's selling that home for $389,000 just 3 years later. That's $124,000 that home went up. Meanwhile, Brad, on the other hand, $1,800 a month, he's paid a lot of money to his landlord that he's never going to get back. This is another example of it not paying off. The swing is probably somewhere of $250,000 that he's missing out on from the rent that he's paid while missing out on the appreciation during that same time period.
Absolutely. The numbers speak for themselves. I think that really helps visualize it, where a lot of people are at. And we work in the industry and help unlock the door, pun intended, to these opportunities. We might sound like salesmen, like These guys, they just want to line their pockets. In reality, we want our close friends, family, acquaintances to make smart financial decisions. We want to see them succeed in the business by being an owner, by being a home buyer and a homeowner. Yes, there's a lot of risks that go involved with that, but the potential gains in the long run far outweigh any risks that you will take going into the process. Bottom line is you have to live somewhere. When it comes down to being a renter compared to being an owner, choose being an owner.
How much of your rent payments can you claim as a tax deduction? $0. Interest that you've paid for your mortgage, that is tax deductible, dollar for dollar.
That's a great point too. I didn't think about that. Even if you're thinking about, okay, well, if I buy it for $240 and I sell it for $230, you're still profiting. You're still paying to live somewhere. But the thing is, you're going to be getting a lot of that money back. So think about that. If you break even or you say, oh, I took a loss on this when I go to sell, maybe the market cools down in 5-10 years. You're still making money because you paid to live somewhere while maintaining the equity in the place. So that has to be understood too. Look through it in a different lens, because it's easy to get caught in the weeds of, oh, I just want to be out this amount per month and I'm going to be fine. And yeah, maybe you will. But when you want to get something back for your investment at the ROI, you're going to be barking up the wrong tree. You're going to be preaching to the choir and not hearing much back.
Your landlord's got a mortgage. You're paying for their mortgage. You know, you're doing them a favor, and they thank you, I'm sure, for waiting to buy. 80% of the people that are renting currently say that they wish they could buy a home, but they can't afford to in their mind. And I suspect that a lot of them probably can afford it. They're just not informed on the resources available to them and educated on the process enough to know what options are available to get them into their home. Maybe it's at a cost of a slightly higher interest rate now. Cliche as it may be, you can date the rate and you marry the home. You get into the home, you start getting the advantage and the benefit of being able to build equity from simultaneously paying down your principal balance and the natural appreciation of your home. So a win-win from just owning your home. Living the American dream, baby.
Exactly. Another story that I like to tell too is 2021. I was towards the end of my lease in East. I was still living in East Lansing at the time, and I wasn't even an agent yet. Looking for a house in that scenario, I was like, you know what? I want to be able to get something that I can put equity into and make payments on, where I'm not going to be losing money in rent payments over the course of 5 years.
That's the cost of waiting.
It's the cost of waiting. And I kind of saw that. I sniffed it out. This is in 2021. Okay. This is in mid 2021 where things were already starting to go back up. They were already starting to climb back up. I'm like, I got to get ahead of the curve here and try to get into something. Meanwhile, I was relatively new in my career and I didn't have a ton of money in my pocket, but I'm like, I want to check out my options. I want to see what my options are as far as, getting a rate, seeing what I can afford. But I got to admit, being kind of a naive home buyer or pre-home buyer, someone that wanted to be in the market, but didn't really know if I could have really done it. You feel like you're being sold something. You feel like you're being sold a false bill of goods. Having that confidence in the people that really want to help you and doing it in such a way where you don't sound like you're selling them something, but rather you're trying to help them out and looking out for their long-term goals. And we have to do a better job at that. For people that don't think that they can qualify, people that don't think they can make their payments or make ends meet, doing a better job of communicating that to potential home buyers, that it is possible. And if it's not possible, we're going to tell you that you can't do it yet. Okay. But this is what you have to do to get there, by creating a path and giving them guidelines on how to achieve their goals and giving them a path to success is the least we can do, especially if they can't get in a home right now, helping them figure it out. That's the key.
Waiting doesn't actually reduce risk. It reduces the uncertainty. And people are stuck in their comfort zone right now with what they know and what they can do to get by. It's a big deal buying a home. It is an extremely large purchase, one of the largest, if not the largest purchase that people will make in their lifetime. It seems that it's smart to wait it out, but it's not actually benefiting you. And it's been proven historically that chances are that there's not going to be a time when rates come down and prices come down in the home. You can always refinance if you buy a home now and you're comfortable enough with the payment that you can make it without stretching yourself too thin, and then rates do come down. You can refinance into that lower rate. However, you don't have that same type of safety valve for locking in the price that the home's at now. If you do wait, it could be at the expense of buying that same home for $50,000 more. Do you want that to be additional equity that you're gaining, or do you want that to be an additional balance on your mortgage that you're paying interest on? I think that's a no-brainer.
Absolutely. You actually brought up a really good point. Let's rewind the tape. Let's go back to the 90s. Okay. Interest rates are at between 15 and 17%. Okay.
Sheesh.
The average home price is between 125 and 150 grand. Okay. So the rate and the price of the home is relative. What the COVID crash did is it brought both of them down. And this is what you brought up. Very good point. It brought the price of homes down, and it brought the rates astronomically down. Okay, down to the surface of the earth, to the crust. Okay, to the troposphere. That's where it brought them. And what it did is it bottlenecked the market and put it in an unrealistic, unsustainable state of affairs, where now we have rates where we call them high at mid fives or high fives or even sixes. But in reality, historically, those are pretty low rates. What's different is the relativity between the rate and the price of the home. So that's what's made it even more difficult and even bottlenecked inventory, because people that did lock in the rate in 2020 at 2% or 3% even, they don't want to sell because they want to hold on to that rate at least until they pay off their home. A lot of people did it. So that's kind of what we're dealing with now. We're dealing with the fallout of that bottlenecking of the market. Buyers, especially first-time home buyers, feel alienated. They feel like there's no way I can compete with these big wigs. I felt that way before I bought my house. I'm like, there's no way I'm going to get into a house. There's just no way. And this is before maybe early 23, and that's kind of when I wound up getting one. We're like, okay, maybe we're at the end. Maybe we're at the end of this. We can kind of see the light at the end of the tunnel here. People would be asking me, because I was an agent at this point. They're asking me, oh, what's the light at the end of the tunnel? How is it looking going into 24? Things are going to come down. They're going to chill out. They're going to retest, right? I'm like, I don't have a crystal ball. I can't tell you, but I sure hope it does. And here we are in 2026, and we're no better than we were. Actually, we're in a worse spot for first-time home buyers. I don't want to say we're in the worst spot because I don't want to discourage home buyers. I don't. And it's really not as bad as the, Zillow, Redfin, Homes.com, as they make it out to be. Not that bad. It's possible. Don't really hold yourself to that of you have to wait till you're 40 years old to buy a home. Don't lock yourself into that mentality, because it's not true.
And I'm thinking back to it was the end of 2024. There was a ton of refi opportunities. It got down to the end of September in 2024, where the 30-year mortgage average rate was 6.24%. All right, fast forward I think it was October 3rd. The rates had jumped up to 6.52%, a 0.25% raise in those interest rates. Let's say on a $400,000 loan, that's an additional $67 per month.
You can prove it time and time again. Looking at the numbers, looking at the lost, we call it lost equity. Assuming you didn't make a terrible investment and your agent was working for you in your best interest and your lender was working in your best interest, you're going to have some equity in your pocket if you went to sell tomorrow. If you bought compared to if you rented since 2020.
And if you look at over time, I think that it's very comparable to if you were to invest in something like, stocks in the S&P 500.
It's almost identical. Maybe not in the amount per se, but you can look at everything. You look at the S&P, you can look at Bitcoin, you can look at gold and silver, which that's a completely different animal. But at the same time, the principle stands true. You didn't get in, so you lost money. So it's, it is what it is. You got to look at it from today's perspective. What am I going to do from today forward to make sure that in 2030, I'm not continuing to lose money?
$300,000 home, if you purchased it tomorrow and it appreciated at a conservative estimate of 3.8% annually, that compounds to approximately $619,000 for that home after 30 years. It more than doubled its value over those 30 years. And that's with a 3.8% appreciation estimate.
That's a 3.8. And obviously there's other factors involved with that, which I think that's a very conservative estimate. But that begs the question too, that we proposed in the green room, of how far upward can it go? How much can it appreciate until it's like, okay, we're at the ceiling, regardless of inflation and all the other societal and economic factors?
It's hard to predict. All we can see is that it is a much higher probability that the values are going to continue going up like they have been. I found something that was interesting. I saw somebody who had done a study this year, actually, very recently. It suggested that restoring historical affordability levels would require either a steep decline in rates to the mid 2% range, which was an anomaly. Can't foresee that happening anytime soon, a 50% increase in household incomes, or a 33% decline in home prices. So we see home prices kind of leveling out, but they're still going up in most places. But if you look at the trend over time, 97% of the time, home values went up year over year. And I expect that trend to continue.
Absolutely. Yeah. I guess without the luxury of having a crystal ball at our fingertips, which I don't know many people, if any, that have one that works.
Mine doesn't work.
My point exactly. That's all we have is past performance to gauge potential future projections. Using that and using conservative projections, that's a fair assessment. That is not outside the realm of possibility.
Story I shared earlier with Brad and Chad. Brad's been paying rent over the past 5 years and $1,800 a month. How much equity has he built?
Zero.
None. He's paid $108,000 to his landlord. Meanwhile, home prices are continuing to go up. That $350,000 home that's now worth around $500,000. So you have the amount from the appreciation plus paying down your principal balance and being able to write off the tax-deductible mortgage interest. That's the real cost of waiting. You've got two groups of people that are renting right now, right? You've got the people that can't buy a home, and the people that are just comfortable that could buy a home, but they think that they're going to benefit from waiting. What's more realistic? I mean, what we can't change is we can't increase the income for everyone out there. Hopefully that happens. The bigger thing that we can control right now is the people that can afford to buy a home. Maybe they know it, or maybe they think they can't, but how do we help those people get into homes now? And now that we've discussed what the cost is of waiting, how do we communicate that to them and help them get up off the sideline?
Yeah, great point. I think it involves, that's like a great question. What that involves is because who are we talking about? We're talking about people that are comfortable renting, people that have a job that maybe they're living with mom and dad, they're comfortable with that. That is a problem. That is a mentality problem. How do you shift the mentality of, if I want to get out on my own, if I want to start a family, create a legacy for myself, I have to get out on my own and find my own place to live, even if it is renting. I think the bigger target, the people that are living with mom and dad, we have to work on those people. And that's a mentality shift that really we can't change for them. They have to make that change on their own. People that are renting have to make that mentality shift as well in a little bit different way. I think that's a little bit easier of a shift to make. But making that mentality shift of, I've already lost money, how can I avoid losing more money going into the future 5 years? We just painted, throughout this entire episode, we painted a crystal clear picture of appreciation potential. Think about the principal that's being paid down. Think about the equity that's being built, because the interest that's being paid is really peanuts in the grand scheme of things. And you want to be able to build that equity.
Tax-deductible peanuts.
Tax-deductible peanuts, exactly. And we painted the crystal clear picture on both sides of the spectrum. Even if you buy a house that needs a ton of work, you're going to sell it for something, and you're going to make something back compared to zero, which is guaranteed if you rent. So you could do that, where you'll make something back, even if you're in the hole a little bit when you go to sell. Or on the other side of the spectrum, which is a picture you painted, I think we both painted to some effect, of the appreciation, 3.8% that we posed as a conservative rate of appreciation. That's the other side of the coin, where you have a big opportunity to gain and make profit on your investment when you do go to sell. No matter where you look at it, no matter how you twist it, slice it, cut it up, there's benefits to buying and owning compared to renting.
Right now, it might not be the best time for somebody who's interested in expanding their portfolio and getting started to go buy some investment properties. But the cost of living, whether you're renting or you own a home, it still costs money either way. One of those options, that money is helping you build wealth, while the other one is being thrown away to money that you don't get any return on. It can be dangerous living at home too. I did it for a semester when I was in college, and I did not do it the right way. Instead of saving money and putting that aside, I thought of it as I don't have a rent payment, so I'm going to go spend this money at Harper's or Rick's, which are the local bars in Michigan State, as you know. When you have a mortgage payment that you're obligated to make, it's a form of forced savings. It's a big piggy bank that you're paying into. You're paying down your principal balance, which is helping you build equity, while simultaneously the home price is appreciating naturally without you even adding any extra bathrooms, bedrooms, both two things that are going to help you build equity and essentially gain wealth, which is why there is such a big difference between the average net worth of a homeowner versus a renter. 43 times more as a homeowner versus renting, which is crazy.
That is crazy. And you mentioned people that live at home for a short amount of time until you get things figured out, right? I was in that boat as well, where I lived at home for a period of time, and maybe I didn't spend money as smart as I should have.
Yeah,
right?
because you think, okay, I don't have this other,
I don't have this hanging over my head where I have to make ends meet. I have to make a payment at the end of the month. Right? You don't think about that stuff. So for a short amount of time, and that's why the mentality shift is people that have been living at home forever. Okay. They're in their careers. They're making money. A lot of these people have benefits. They should have some money saved up. Okay. They should have a nice, really nice, juicy nest built up by now. They have no intentions of moving out because they see it as a long-term plan of, I'm going to stay at home. I'm going to save money. And I don't have this external payment hanging over my head where I have to pay it. They think about that as a problem, when in reality, that's a privilege.
Meanwhile, you rewind back and they look at the amount of time that they've been at home, and you look at how much home prices have gone up and how much they've missed out on that appreciation that they could have been gaining. That offsets the amount they could have saved by not having a payment. It really does.
Exactly. And I don't want to sound like I'm harping on people for living at home. Everybody's financial situation is different. And if it's what works for you and what's right for you and your situation, then by all means, I support you.
That's what it boils down to, is you've got to buy a home when the time is right for you. You can't try to time the market. Historically, it's proven itself time and time again. Base buying a home off of your own personal circumstances when you can qualify for it. The long-term benefit is going to be there. Got to have faith in that. You've got to look at the history because, like you said, it does tend to repeat itself. And work with the experts, figure out exactly where you stand. Ask yourself if it's realistic for you. What are the signs for somebody that it is a good time for them to buy a home? Who's somebody that's a good candidate to buy a home versus somebody who's not?
Absolutely. Great question. Hope this video and episode and podcast does this, is flip a switch, give you a reality of where you're at and where you should be striving to be if you're not there. And that is seek out ownership, seek out being out on your own first, even if that involves renting. The two different groups, rather, of people that, one that is, in a position to get a home, but maybe they're renting, maybe they're living at home, whatever.
These are both groups of people who do not own a home. And there's the people that can qualify, that could buy a home. And then there's apparently 80% of people who do not own a home and want to own a home, but they're not able to afford it.
Right, exactly. So we'll start off with the first group. People that are renting, but they have a career. People that can qualify, that might not think they can, but they want to. And in reality, they can with the right tools and right steps and right actions that are taken. So people that have a steady job, you have income coming in. That's the most important thing. And you got to have good credit too. This is the second category now. People that have bad credit. Okay, they can't get another loan. They can't get another line of credit. Mm-hmm. Those people need to do some credit adjustments first. Get your credit figured out, have some money coming in, and be able to prove it somehow. Get something on the books where you can prove that you're bringing money in. You got to have money coming in. That should be your first goal. Get your credit figured out. There's people that are out there that have good money, that have money coming in. They might not be able to prove it, and they don't have credit because they don't use credit cards. They pay everything in cash. So I would suggest to those people, they got a steady job, but they don't have any lines of credit. So
there's resources
can't
for those people.
They can't qualify until they have a line of credit.
I have a lot of the same ones. Okay, it comes down to your credit, your income, and your assets. Some of those you can work with. Assets, for example. We can help people come up with the down payment if they need some down payment assistance options. So we can work with people on that. Credit, there's other resources out there that can help people build their credit scores back up. You can start doing things like reporting your rent payments is something that's newer that will help your credit score. You can go get a secured line of credit to boost it up. Stable employment with sufficient income, I think, is the most important as far as being able to afford your monthly payments while still maintaining your other financial goals. Maybe you have other investments that have a high return on your investment, and you don't want to have to neglect those in order to get into the home. So you do want to have sufficient income. You want to be settled in your career and comfortable with the geographic location. So assuming you're going to be into the home for 3 to 5 years before you look to go sell, I think is a good rule of thumb. And you want to have some sort of emergency savings, not stretching yourself too thin. Maybe if you don't have a ton of savings, looking into some down payment assistance options. Maybe you do a first and a second lien. So you have a line of credit available to where you get a HELOC, a piggyback HELOC. I think we can work with assets. We can work with credit. We can get them in touch with the right people. But most importantly, a stable employment history of at least a couple of years or education history likely to continue going forward unless you know for sure it's going to be increased income. You want to make sure that you're comfortable with being able to make the payments based on your current income. We can help people understand all the facts of what the expenses are into buying a home, but we can't increase their income for them. And right now it's a tough time for a lot of people as far as the cost of living in general compared to the amount of income and the entry-level positions available. It's a lot harder than it used to be for somebody right out of college to go and find a job that pays them enough to live and to have some left over after that. So I understand it. I think that's a big reason why 40 years old is the average age that people buy their first home, because of the lack of entry-level positions and sufficient income that's available out there. So go get some money, I guess.
Easier said than done, Carter. You know what I mean? But yeah, I think you hit all the bullet points and explained them, let's just say, a little better than me, because you're the numbers guy. You're the numbers guy, right? So I would go to Carter for the numbers, go to me for the schematics and for the floor plans.
Are you trying to hypnotize people, or like, is this some sort of subliminal messaging going on here? What's going on?
We're trying to put everything on the table for you. If we didn't put it clear enough, hopefully we do in the future, subsequent episodes and subsequent posts. That's our goal, is to make everything crystal clear for people, to give them a roadmap, to give them
if you can afford
options.
The payments, buy a home. How's that for clear?
Absolutely clear. I think that what I am really pounding home harder is the mentality shift of people that don't think they can do it, to shifting that mentality into, this is something I can do. Maybe if I can't do it right now and there's outside external factors that are preventing me from achieving my goals, then that's one thing. But shifting those goals into, I want this. I want to own a home. That's the first thing. Then everything else kind of comes after that. And then if you're not able to do it right now, then do what it takes to be able to do it someday. You're always working towards that goal of home ownership. That's my goal for people.
You can always refinance when rates fall, but you're not going to be able to recover those lost years of building equity, of appreciation. Values, they probably will follow along the same trend that they have done 97% of the time historically, which is still continuing to go up. So imagine that. Worst case scenario would be both rates and prices go up. And then you're really screwed instead of winning by getting into a home and starting to build equity and gain wealth. Especially right now with still limited inventory. That's another cost of waiting, is when rates do come down, the demand's going to go up, price is going to go up. It's going to be harder to get your offer accepted. Why don't you work smarter by working with John and Carter instead of working harder? Damn it. I need some water.
Yeah, there you go. I was just going to say, just kind of tying in everything I already said, is start with the mentality, start with the want, start with the drive, then write it down. Next, go to the experts, go to me, go to Carter, figure it out. Okay. If you go to me, I'll probably send you to Carter. Okay.
The numbers guy.
To figure out the numbers, figure out the brass tacks of where you are at financially. That's what we care about. We also care about that you're going to be able to make those payments. Okay. We'll help you out every step of the way. We want to help you out. That's our goal. We are satisfied when we help people and we help unlock those, goals for people. They have to have that drive and that want themselves. We can't give them that. We can say it, we can spew information all we want on this podcast, but unless they want it internally in their heart and in their mind and in their soul, then that's step one. If they don't have that, there's really not a lot we can do.
They might also be able to get some seller concessions right now. If they start looking into it, see what's out there, and start talking to the experts. They want to know the numbers, they can talk to me. They want to find a house, they can talk to you. They want to know the process, they can talk to either of us. We'll get them in touch with the right people if it's not us directly. So they're going to be talking to the right professional so that they can make a fully informed decision and not one based off of what their neighbor told them or their cousin that almost became a real estate agent. It's getting the right information to people, no matter how that may be. I just want to reiterate that we are available and it doesn't cost anything for you to inquire or for you to ask us some questions so that we can help you start preparing, whether it's now or in the future. We can help you evaluate how good of a decision it may be for you or it may not be for you. Reach out to me or John and we can help get you moving in the right direction.
We both work for you. We're the messengers. We're the experts. We're the ones that go in and find the information, do the hard lifting for you. That's our job,
bake, baby.
That's our job, and we love it.
Shake and bake.
Boom,
nuts, dog.
It's fun.
Yes, too much fun. Shit, now we're in. All right, well, hey, John, I appreciate your time. If anybody is, hopefully you got something out of this episode. And if at least it got you thinking about what's the considerations going into buying a home, if nothing else, there's no better feeling than showing somebody that it actually is possible and that they can benefit in more ways than just one from owning a home, the American dream, and starting to build that wealth.
Absolutely. It's ultra satisfying. You think it's satisfying for you guys? It is, but it's almost more satisfying for us to be able to help you find and unlock that potential that you've had all along. Feels great.
It's very rewarding to help somebody achieve that goal of homeownership, which is referred to as the American dream, by showing them how easy it can be, educating them on the benefits of homeownership. There's no better feeling than that. That's why we do what we do. I mean, that's a big part of it for me. And I know from our conversations, I think you feel the same way.
Absolutely. That's the number one reason I got in this business is to help customers, clients. They become family throughout the process and to see them through that purchase years into home ownership, checking in on them, seeing how they're doing. How's the house looking? They send us pictures of, hey, I just updated this backsplash in the kitchen, or I put a new wall in behind the fireplace, or we put new floors in. That stuff warms our heart to see because they're making that house that they bought into a home. And that's our ultimate goal.
Any way we can help out, I want to stress it again because I can't stress it enough. John and I are here to help. Give us a call. Don't hesitate. Shoot us a text message if that's how you like to communicate. But don't let not knowing and the uncertainty stop you from looking into buying a home and stop you from all the benefits that come along with it.
Absolutely. We'll see you on the other side.
Thanks for tuning in to the House Rules Podcast. We'll see you guys next time.